Okay, good afternoon, ladies and gentlemen. Before we do the panel, I will be showing 2 slides in terms of introduction. Then we will bring on Fabrizio, because it's an either or. You can either see the slides or Fabrizio. Actually, we could take a short Slido. Who wants to see the slides and who wants to see Fabrizio? Okay. Only joking, Fabrizio. So I will present the European market infrastructure on a slide, and then the US infrastructure as a sort of scene setter for the panel. Then we're going to put on Fabrizio, and then we will introduce all the panelists. So there you go. So this is America, equity market structure in America. Pretty straightforward. You have 2 listing exchanges, and you have 16 trading exchanges, and they all have the same portfolio. So you list on the New York Stock Exchange, on NASDAQ, and you can then trade the New York Stock Exchange on the NASDAQ listings on New York Stock Exchange, and you can trade either the NASDAQ or the New York Stock Exchange listings on CBOE, on IEX, and all of the exchanges. And why is that? Because all the trading goes through a central clearing and settlement. The NSCC, the National Securities Clearing Corporation, and then it's settled into the DTC, the Depository Trust Company. That allows everybody to trade everybody else's listings. It's a pretty complex structure, but it's still relatively straightforward. So take time to digest this. That's the American market structure. And then, once you've seen this, take a big pause, because now we're going to go to Europe. Ta-da-dum! Next slide. Wow, look at that. So just take a moment to just really digest what you're seeing. And it's obviously many more exchanges, many more clearing and settlement infrastructures, but still there is kind of a bifurcation, if I may say so, because you have one section of the market here, which is Euronext and CBOE and Acquis and NASDAQ and the SIX group, and they still have some integration when it comes to clearing and settlement, because it all flows into either the CCG, EuroCCP ClearNext, and then it unfortunately dissipates again a bit when we come to the settlement stage. So that's the left-hand side of the slide. The right-hand side of the slide, starting here, so Wiener Börse, Zagreb, Poland, lots of small countries. It's kind of a totally different infrastructure, because you list and you trade and you clear and you settle in a vertically integrated silo. And that explains why, for instance, shares on the Polish stock exchange, on ATEX in Greece, you see the member states in the line above. These shares are not actually traded on, for instance, CBOE or on Acquis. These shares are only listed, traded, cleared, and settled in a vertical silo. And in our mind and in our analysis, there isn't a lot of fragmentation, because the clearing structure actually is pretty much vertically integrated with the trading and the listing. And on the other side of the slide, there is not perfect competition like in America, because still, if you list on Euronext, you can't be traded on NASDAQ, and if you list on Deutsche Börse, you can't be traded on Euronext. But the shares that are listed on Euronext and NASDAQ or Deutsche Börse are also traded on some of the main alternative platforms. So there is fragmentation, and there is, as you see, more integration than when it comes to clearing and settlement. If there's fragmentation on trading, there will be integration on clearing and settlement, because they all need to be interconnected to a clearing and settlement platform in order that a share is traded on more than the listing exchange. So this part of the slide goes in the US direction. It's still far from it, but the right-hand side of the slide with the vertical silos is like totally different to the US. And that's the backdrop against which this panel will discuss a variety of issues around market structure in the European Union, making the European Union more competitive, deeper, more integrated, more attractive for international investment, because we want to come to something which is, when you go back, which is a bit more like the previous slide, a bit more that you can trade many shares on many different platforms, because there is an integrated clearing and settlement, so there is no silo and there is no technical impossibility to have a bit more competition up front. Now, there are various projects to this. I don't want to anticipate the debate on the panel, but this is like the economic backdrop against which we will be discussing European market infrastructure reform, what needs to be done. With that, the slideshow is over, and we'll get Fabrizio on the screen. I shall be taking my place. And while Fabrizio is being beamed on, I've let the panelists introduce briefly themselves, their background, and how they approach this debate. And we start, ladies first, of course, next to me, with Gesa.
So, Gesa Johannsen from Bank of New York Mellon. If you saw the picture just now about the US market infrastructure, that was the equity market, turn it to the treasury market, then you would see one central provider of clearance in that market. That's BNY Mellon, and we operate that through our subsidiary GSS. And if you turn it to the collateral market in the US, there's one single provider, BNY Mellon, that operates the collateral ecosystem for the US tri-party repo market. And if we then turn it to Europe, it's not as fragmented as the picture that Tilman has shown for the equity market. In Europe, we have obviously a number of tri-party agents, BNY Mellon being one of them. I would count probably 4 large tri-party agents for Europe operating the collateral market infrastructure. So my role is operating some of the important infrastructure for Europe through my role at BNY Mellon.
All right. Then let's move on to Felix.
Thank you. And thank you to AFME for the invitation as the Dutch Authority for the Financial Market, where I work for and responsible for transaction reporting and market abuse supervision. The concept of deep, liquid, fair, and integrated markets is one of our objectives. And definitely due to Brexit, we have been even more confronted with the fragmentation Tilman was explaining through the slides, where instead of basically Euronext as a platform, we have now multiple platforms to supervise. And for example, data quality is one of the focus areas for us, where I would be very happy to explain a bit more what we are doing in that respect. Thank you.
All right. Then I guess we'll go around. So Fabrizio, you are like virtually facing us, so you would be like next in the order.
Hello everyone, Fabrizio Planta. I'm the head of the Markets and Data Reporting Department at ESMA. How do I take out of the slide is certainly the fragmentation, but also the fact that in Europe there are single rules, all these trading venues and the market infrastructures need to comply with, and certainly our role is to ensure that those rules are consistently implemented. So one comment on the slide, if I may, although it's fragmented and I don't want to dispute that, there is at least one single settlement platform in Europe, which I think it was not reflected, and certainly this is a driver toward integration and harmonization, and I think it's worth mentioning given the huge effort that the ECB has put to establish T2S.
Okay. And then on the other side is Jürgen from BaFin.
Yeah, good afternoon, everybody. It's a pleasure to see persons as persons and not only on the screen. Happy to be here. I'm head of the Market Supervision Directorate of BaFin, that's the German financial regulator. I got that job only recently at the beginning of this year and have been around on secondary markets a couple of years ago, but I'm still new to this discussion. Referring to the charts we saw, well, obviously Europe looks very fragmented. But I wondered how the picture would look like if we would have weights or volumes on each layer. So this picture looked like, well, every exchange had the same size, every CSD had the same size, and so on. I don't know whether it would be possible to amend that picture, but perhaps it would look a little bit differently.
Absolutely. I think the picture tries to achieve that. So we can't have the picture because then we lose Fabrizio. But and again, it's your choice. It's the audience choice. I mean, but the picture tries to achieve that because some of the main exchanges with the big volumes actually are highlighted in a background, and then the small exchanges on the side, they're in a very light color. That means they are low volume. So mostly the integrated exchanges, the vertically integrated exchanges, they have very sort of few issuers and low trading volumes. And as you go to the other side of the slide, the big exchange groups, they tend to have, of course, the higher trading with the bigger volumes. And then Deutsche Börse, this sort of relatively vertical strand with Deutsche Börse and Eurex and Euroclear, that is kind of a bit the outlier because it has like super high volume, but it's relatively still vertically integrated. But you have lots of cross-references because a lot of the Deutsche Börse shares are, of course, on the alternatives, and therefore some of them are also cleared in a centralized way away from Euroclear. Okay, now I think I want to go back to Gesa because you mentioned that you had kind of comparable issues with collateral and collateral management. So why don't you tell us a bit more about that?
So, I mean, first of all, I think if we want to look at competitiveness of the European financial market, right? How do we define competitiveness? I think first we have to agree on how do we judge what we deem competitive. If I had to define it from a collateral perspective, right, it requires to have easy and open access to financial assets. It's required to be transparent, harmonized across Europe, reliable, right? That's how I would define it. And it needs to be cost efficient. So, and even though I agree, we could only look to the large exchange groups and the large CSDs, but unfortunately in the collateral market, that's not how it works, because it's about mobilizing all different assets, and we have to give access to all markets in Europe. And you, in the post-trade landscape, you then have to harmonize to the least denominator, right? So we have to end up discussing every single nuance of European market. And if I have to summarize this, I mean, I think the integration of the European market is at best incomplete and inadequate to operate efficient collateral markets. And the result of it is that there is not enough liquidity and that European banks have higher intraday liquidity costs than their competitors. And that matters to us, right? Because we want our banks to be competitive. So while there and Fabrizio, I would probably remind me, I think we've had years of work on improving our infrastructure for Europe. T2S is a good example, and I think we've achieved a lot through it, but it was also an intense journey of working groups to harmonize to the standards. We have a similar example. I'm the chair of the Collateral Harmonization Task Force for Europe. I think the Euro system is doing a good intent by launching ECMS as a single collateral management system for the central banks in Europe. So it's again, the carrot is there for the market to move to one harmonized model, but it's about harmonizing to the common denominators.
You said in a preparatory conversation we had that CSDR was kind of like a missed opportunity because it didn't really enhance interoperability. What should we have done differently? Well,
yes, I mean, I would think that there is still probably lack of political willingness or interest to harmonize, and obviously also lack of economic interest to harmonize infrastructure, right? So you've shown all of the exchange groups. What is the true economic interest to make European markets more open access? I think we have to be honest with ourselves, right? That there are certain hurdles for us to achieve this in Europe. And therefore, we stay on a journey, really on slow improvements of our market infrastructure. The question is, I think in the previous panel we've mentioned digital assets. Is there the chance to do it better with the next market infrastructure?
We'll come to digital in round 2, but I want to bring in Fabrizio on this one, because you seem to say that we actually did achieve quite a bit of things. So why don't you expand a bit on what has been actually achieved in this front?
Let me say that certainly in terms of capital market union, some progress has been made, but still there is a big journey ahead of us. On the CSDR, just to respond, we have at least one example where it led to more consolidated in the Baltic, where we have a model with one CSD and different branches. So I don't know, it's limited, but still we are only a few years from the implementation of CSDR, and actually the settlement discipline only started a few months ago. Now, turning to the Capital Market Union and the initiatives ahead of us, let me start with the consolidated tape. Tilman, I'm sure you will appreciate that, and also have full support that we have on these initiatives. So currently we don't have one. I don't need to tell you. You are putting a lot of efforts into that, and certainly I believe that we are working well together with our review report that was well taken into account in the Commission MiFID review proposal. I think that this will be a good initiative to ensure that the market participants can rely on consistent and reliable records of executed transactions, and it's certainly it will certainly contribute to the CMU. Still, we have a few, without going into details, a few concerns on certain elements, particularly the need to ensure that the requirements applicable to CTPs, trading venues, and APAs are the same as the data to be submitted to the consolidated tape. And I think that we need, for the successful of it, to ensure that we have a meaningful and less complex deferral regime. Mm-hmm. Now, turning to another initiative still in the fields of data for CMU is ESA. So ESAP is a flagship project for the CMU. It will be constructed as a central platform, enabling anyone to find in one single place in digital format and for free financial and sustainability related information. Thus, ESAP will save investor time and resources in finding the relevant information to make sound decision, and will give companies more visibility towards the EU and international investors, thus achieving one of the objectives of the CMU to open up more sources of financing. Though the CMU is not just data, it would be too easy to just attract capital with the better data. I think that there are also other important initiatives that the Commission is putting on the table, like the Listing Act, that includes a number of initiatives from prospectus to MAR and corporate governance. The goal is to reduce the burden for listing and make the EU more attractive. We are following closely these initiatives, making sure that they provide incentives also do not put at risk effective supervision.
Okay.
Finally, let me spend a couple of more words in the context of the EU market competitiveness, because recently I hear a lot of requests to always align our rules to the UK and the UK wholesale market review. So I agree that our regulatory frameworks needed to be adapted to new development, and that we needed to be open to correct our provision, but I would also warn not to blindly copy the UK approach. We needed to assess what is good for our market, for the orderly functioning of markets and the protection of investors. Of course, keeping an eye on competitiveness, but without losing sight of the broader objective.
Okay. Yes, we'll come to the details on this. It's difficult to cut you off because you're on the screen. Jürgen, I think, wanted to, because, I mean, we are addressing, as always, I have to say, at the Commission, we are addressing, as you rightly pointed out, the first two layers of that slide. So the listing and the trading. And then, of course, there's the clearing and the settlement, and you say that some progress has been achieved, but maybe more can be done in terms of integration. So coming maybe, and maybe that's something for the audience, if you want to ask questions, is this really the right approach? Is it always right to do only the first two layers and be a bit more relaxed on the other two layers? But that's maybe for the audience at the end. But Jürgen wanted to come in on this fact that there is a concern that we have lots of startups, we have lots of business ideas with lots of good companies, but when they then list, they go abroad because the pool of investors and the pool of capital seems to be bigger. So what would BaFin like to see in terms of making Europe more attractive as a listing jurisdiction?
Well, I'm not sitting here with a wish list. When I said that in the prep call, I was thinking about what the term competitiveness means to me is when I tried to answer the question. And the attractiveness of markets for listings was one point. And the other was, well, is a market, not a company, a market competitive if its entities or its main entities have the same size as entities in, say, the US or UK. So this was one aspect. And taking this as a benchmark, probably Europe is not really competitive. I think one main point, and you already touched that, is the market attractive for listings, new listings? Well, to make the point first, I guess there is room for improvement. Fabrizio mentioned the Listing Act. There will be done something about prospectuses. I don't think that, well, that's useful, but it won't solve the problem, certainly not. And I brought one example, since we are here in the city of Frankfurt. You probably know the company BioNTech, that's the firm with the vaccine against the SARS-CoV-2. So they have been listed, I don't know exactly, 10 years ago or so at NASDAQ. So Mainz, the city of Mainz, where they are located, is 45 kilometers from here. It's a short journey. But I wondered, and you will see, I don't have really an answer to your question. I wondered, what's the problem? So they set up shop in Mainz. They developed a product over a decade, and let's say 10 years ago, we wouldn't have known that this would be a successful company. Today, the city of Mainz is happy in receiving all the taxes the company is paying. The funny thing is the street where the company is located, the English term would probably be something like gold mine. That's not a joke. So they pay a lot of taxes. The city of Mainz is happy. A lot of people have good jobs, and a scientific cluster is emerging in the city of Mainz around the university and the company. So this does a lot for the economy. It does a lot for the society as a whole. Probably it would be nice, at least for Deutsche Börse, if they would have been listed in Germany, receiving the fees. But I wonder where the big disadvantage is having them being traded in the US. I'm not certain, but that was one point. But I agree, the ability to attract new companies to European markets, or markets in Europe, is perhaps a better term, is probably useful. We should go for that. And well, we don't like to see startups, when they do their exit, that they do the exit in the US, for example. And, but coming back to the term competitiveness, I also wondered, is a market competitive if it's accessible for newcomers? I'm not really certain about that. I think things are improving. Just to name neo-brokers, which are, some of them are already listed. At least they change the rules within the market. And in my training as an economist, I learned that the perfect market is a market where you almost have no margins. I don't know whether this would be a benchmark for competitiveness when make a judgment for European markets.
Okay. I think we're a bit more modest. We just say that we want to have more international interest in the European capital markets. We want people, when they look at the markets, to know what the prices are, what the volumes are, where they can trade in Europe, at what any given moment in the day. Because if they don't really know, and if they want to trade a particular company, and they get 5 different answers and 5 different prices and 5 different pieces of information where the main liquidity pool for that company is at this stage, then that might be a bit frustrating. And they might go elsewhere and then say, okay, we'll invest in the US. The same is true a bit for ETFs. If you want to buy the UCITS version of the ETFs, that would create, as you said, a lot of good jobs in the European Union. But if you don't know where that UCITS ETF with that particular investment style currently trades, because the information is fragmented all over the place, you're going to buy the US version of that ETF. And that is really then annoying, because we want to create capital markets with our ETFs inside of the European Union. So that's kind of like the Commission's ambition with this. But let's turn to Felix, because the European Commission greatly appreciates that the Dutch regulator has actually taken the consolidated tape to heart, and obviously chosen the easy one, which is the fixed income and not the equities, but okay. Some other regulator, maybe BaFin, will take up the equities. But the Dutch have done something really great. They have instituted a sandbox, a platform, where the tech companies who would do the data consolidation and the stakeholders who would be the data consumers, they get together and they talk about how this data should be consolidated, what would be the formats, how do you sort of display a bond, do you display that? Oh, Fabrizio is here, so that's the usual debate, right? Does a bond trade in notional as and is priced as a percentage, or does a bond trade in units and then it's a price per unit? So that's kind of what the stakeholders are debating in this Dutch sandbox. So Felix, why don't you tell us a bit more about the sandbox and where you stand, and how quickly you think that tape could actually, from your perspective, take shape?
Thank you, Tilman. It was a perfect introduction. There's hardly anything to add. But as I said already in my introduction, due to Brexit, we have been confronted with particularly the fragmentation in the bond market, and where you see kind of like limited transparency and high volume OTC. And therefore not a deep liquid market as the CMU envisages. So instead of just telling policymakers we are really supportive of a consolidated tape, we thought about setting up an innovation sandbox, whatever you want to call it, inviting a few fintechs to explore what it actually means, so that we could also feed in with a bit more input to the policy discussion taking place in Brussels. And where we find through so we have asked all the fintechs participating, can you please set up some proof of concepts? And basically the outcome is data consistency. So that's also why I said in my introduction, data quality is absolutely key, where you see indeed the ambiguity about rules which do not make exactly clear. And the example Tilman provided is spot on, whether in notional value or in a percentage. I mean, these are key issues, and apparently we do not have yet a common understanding, while I think all market participants have a common understanding, but the rules do not provide for this prescriptiveness. So that's definitely an area where we concluded with some high-level principles with the fintechs, and we have the ambition to also move towards equity. But the point, and Tilman is asking me when should we do it, I think, and there I'm definitely looking at you, Tilman, the time is now. So also on a more positive note, I think there is now the momentum to do it, because this is exactly an issue which is where we can address the fragmentation through concrete work of the legislators. And there is some resistance with regards, because it might change the business model of certain market participants. But we, as the AFM, we believe that ultimately such a consolidated tape will also provide new opportunities for market participants. And clearly that also takes into account what Fabrizio was saying, that we have to make the deferral regime spot on. But let's do it now. Let's not wait anymore.
I think I would want to echo this also for everybody. Don't wait until the legislative process on this thing has come to fruition in working on data quality, reporting standards, developing a common view. How do we want to consume this data? So do we want to see the bond priced in percentage? Do we want to see the notional as opposed to the unit? Do we want to see what is our reference database? Where is the golden source? I warmly recommend do not wait until the legislative process has come to fruition. We have a political agreement on the rough framework, and then only do we start working on the data standards, because then we'll have to start again several months working on those data standards. We should now have the working groups, we should now have the stakeholder engagement on the future data standards for the tape, so that when the legislative process comes to fruition, we can immediately then adopt the data standards and not again wait 9 months for that consultation on the data standards. So please do that in parallel. Do not wait for a full political compromise on this. Round 2 is about digital. I think Gesa already mentioned it a bit. Are we going to solve all of the issues that we have? Or are we going to just say, well, look, there will be a big technological wave in the future. There will be sort of distributed ledger technologies. What about all this backroom stuff that you're constantly talking about? Once we have a functioning blockchain and you add all these transactions on top of each other, is technology not going to solve all of these problems? You seem to say, to a certain extent, yes, but you were not entirely sure.
I think technology by itself is not the answer, right? And I cannot agree more to the need to have this consolidated data and tape. And to be honest, it will not be any difference just because the technology layer changes. So from that perspective, I think we anyhow will see that we are in a coexistence of our existing infrastructure, and we need to stay focused on improving it and working through those data questions. But obviously digital innovation has, I think it brings a lot of opportunities for us on all of the layers that you've described, right? It could attract the attractiveness of our market, because it might attract new investors. It could attract new issuers, because it's simply easier to issue on a new technical infrastructure, right? So from that perspective, I think there is, if we do it right in Europe, we have the option to become more attractive from that perspective. By itself, the technology makes it more easy to create open access on an infrastructure, because that's the whole idea of distributed ledger technology. So from that perspective, I think also that question in Europe could be resolved. It has designed into it a form of integrity of data, again, that sits within the open source infrastructure. And we've discussed a lot that we need integrity of financial markets. And there's also the ability for us to make it more cost efficient, because if we are frank between those different layers, think about the relationships between CCPs and the clearing members. Our existing infrastructure is built on constant data replication. We are all building our own data on our own systems. We then have to reconcile the data. So obviously that's not very cost efficient. So new technology has the benefit of hopefully allowing us to become more cost efficient. But by itself, technology is not the answer, because we will then still sit here and we need to have a common legislation and common regulation of how do we treat digital assets. How can I make sure that I can create title on a digital asset? How can I make sure that I can liquidate the digital assets when I run into an insolvency, right? So the questions by itself are still, at least for me as a collateral practitioner, they are the same. And to some extent, we are also dependent on our national legislations again. But we might have the chance now to define really the lens of how we want to look at those new digital assets or also tokenized assets now, more harmonized.
But I mean, the issue is, would it be simpler to legislate? And I agree with you that we still have a legal framework that has to be there. But would it be simpler to say that a title transfer on a digital ledger technology might be easier to legislate than a title transfer which goes into all of these different clearing and settlement systems?
I think there is the difference currently, right? And there's to some extent even a competition of lawmakers currently in the world, right? I mean, looking to Germany, right, has taken a pretty proactive approach on digital regulation. Japan really as well treats these as completely new assets, whereas other frameworks, the UK, you still look at it from a UK law common perspective, and you try to apply the same principles to financial assets, right? So that's exactly the question where we need now common regulatory approach on how do we want to deal with these assets in the future.
But that sort of seamlessly brings us to Jürgen, because what's actually the BaFin view? Should these digital assets, so either tokenized securities or even digital natives, so where it's actually issued as a digital asset, do you think it's better to just integrate these into the existing framework with all the sort of investor protection rules? Or is it more the BaFin approach to say this is actually a new asset class and it needs idiosyncratic regulatory accompanying measures?
Well, with regard to regulation, there is that's not our job. We are not the regulator, we are the supervisor. But we did some first steps. So we have tokenized securities in Germany using several blockchains, and I think it's almost 3 years ago, we started to think whether these crypto assets are financial instruments as defined under MiFID. And if they fulfill the requirements as set out in MiFID, then we treat them as financial instruments. So we have seen a number of issues, mainly bonds, some shares. Of course, you can't list them, you can't trade them, but you can issue them by using a securities prospectus. So that's something we did. It's small issuance. It's a couple of million. So we are not talking about
Sandbox.
Volumes. We won't consider this a sandbox, but you might call it like that.
Yes.
Since, yes, firms, and in particular law firms, have been collecting know-how in how to design these crypto assets. So that's something what we do as a supervisors. We think about what's the current legal framework and how we can, do these things fit in. The second part I would like to touch on is, I think Gesa had that in mind. The German Parliament last year enacted a law, it's called Electronic Securities Law, which enables or allows the issuance and the administration of certain crypto securities in a blockchain register. So in order to run such a register, you need an application, a license by BaFin. So currently my colleagues in banking supervision are working on a number of applications. And well, I checked the BaFin website a couple of days ago. We have, I think, 10 of these securities already. Again, this is a national niche. So, but it's a first step. this act, this Electronic Securities Act, is currently limited to bonds only, but the government, well, has plans to enlarge that into shares, into equity, which is much more complex, but that's the plan. So this is the first step, but yes, it's only a corner of the capital market, a small one.
But the interesting part, you said that they can be issued, but they cannot be traded.
Yeah.
And but of course, the whole capital market thrives on the fact that post-issuance you have healthy secondary markets. So when is that step actually going to be that they're traded? And of course, once they're traded, you need to do the property transfer and the title transfer. What is actually the plan to make them tradable, transferable securities, as we say in MiFID?
They are transferable, but not on an exchange.
Okay.
Yeah. So you might transfer ownership. I'm not able to describe the process quite now, but we don't have trading venues for those things.
Okay.
We don't have CSDs. That's an area where we need the amendment of European legal framework in order to treat these things or make them alike like the ordinary, well-known financial instruments.
Okay. Okay. In the interest of time, I'm going to kick off the last round, which is about regulatory convergence, and we'll turn to Fabrizio because that's essentially, of course, his job. So what is actually driving this capital market union and integration? Is it that we first need to create a sort of more integrated, more harmonized, more unified regulation, or should we wait for the developments and the players to sort this out, and then start to see whether this requires a more unified regulation? So it's a bit the chicken and egg issue that we always have. Do we attract more capital market activity because we offer a uniform and harmonized framework, or do we wait until there's more activity and then decide whether we need a uniform and harmonized framework?
So actually, this is still very much linked to the previous theme, in my view. In my view, if you have a new sphere, a new area, and you start from an EU framework, then you have much better chances that this is less fragmented, because you start from the beginning with a uniform and single framework rather than a collection of national one, and it's much more difficult. So actually, innovation that was discussed before could give an opportunity to actually start with the right foot. And in particular, and also linking to what Jürgen was saying, the DLT pilot project is probably a good initiative to experiment the issues that Jürgen was describing, and I think it's also a good initiative to have an EU sandbox, what Felix was mentioning before for the Dutch. So it's certainly worth making all the effort for this to be a success, and to further explore and reuse this model potentially in the future. So, this respect, ESMA is already working on the DLT pilot, given the application in March, working on common templates, coordinated reviews, and so we really start from the beginning with an EU approach. So that's very much.
So basically, you say put in place an attractive framework, harmonized, single shop, and economic activity will come because it's easier to do it like that. So I mean that again segues into Jürgen, because in the previous discussion you said there is sort of a need for convergence, but there isn't a need for a common law in the European Union to be competitive and to attract business. Now, in light of the, in my opinion, rather convincing case that Fabrizio has just presented for having one set of laws and one set of registrations, isn't it necessary at some stage to just say we need to have this single rule book because that's going to attract economic activity?
Well, I think but perhaps a kind of, say, personal statement. Coming from Germany, I am accustomed to, say, a quite decentralized landscape, and the term subsidiarity was around, well, 20 years ago, and then it vanished somehow. So I think I'm very much a fan of this principle of subsidiarity. However, if you can make the case for centralization, then you should go for it. And I think Fabrizio mentioned two items. That's the consolidated tape, for example, or ASAP. I think that's items where we are on the same page as BaFin and Germany. So I won't oppose fundamentally centralization or convergence. I think convergence is probably quite often a solution. However, I would be skeptical about saying, well, centralization or convergence is always the answer. So I'm more...
But think about creating a single legislative framework for what we have just discussed, the transfer of digital natives.
Absolutely.
That would not be infringing the principle of subsidiarity. If you have a European statute for issuances, trading, and property transfer of a digital asset.
As I said, I named the example of what we did in Germany, and I said it's a German niche. Okay. we can't take all the advantages this technologies might give us, since we are limited in the legal framework. So we need to adopt that. That's a European framework. So yes, the answer is to your question is yes. Okay, we need that.
And then the other regulator on the panel, Felix, what's the AFM approach to convergence, single rule book, especially for new asset classes?
Yeah, thank you. I think it's a very relevant debate whether you need bespoke rules or already rules which are in place. I think one of the suboptimal examples is MiCAR, which is now going through the legislative process where kind of like bespoke rules have been developed. And from a positive perspective, you could say, well, that is a first step in regulating this market. At the same time, it will definitely not provide for an effective regulatory structure, for effective supervision of this market. So perhaps it might attract economic activity due to the fact that there will be some kind of like stamp of approval due to the fact that there's regulation, but due to the fact that it's very incomplete. For example, data reporting is absent in that proposal. Makes me say, well, why didn't we use MiFID? Everything is already in place, and perhaps you might need a few tweaks and changes in the MiFID setup for such a crypto market. So that's one of the positions the AFM is taking. Another area which is already happening, algo trading. 75% of equity trading is already done through algos. Where we perfectly use the MiFID setup, but at the same time we see suboptimal testing by investment firms and trading venues of the algos used, and definitely they are not checking what the effect is of one algo to other algos, so they basically only check their own algo. So we have also set up there kind of like a simulation environment to do that testing. And with that understanding, we might come up with some proposals saying, do we need bespoke rules for algos? Do you need to get a license for an algo, for example, or do we need to pre-approve the design of an algo before you use it on the market? I'm not saying that's what we're proposing, but that debate might come in the future.
But you essentially say, let's not create a lot of sector-specific rule books. Let's use the existing general approach like MiFID, MiFIR, and then accommodate other asset classes to the extent necessary, but not create bespoke.
Well, I've heard also in previous panels, kind of like the call, almost the desire fix the rules, please. And if we create kind of like a lot of bespoke mechanisms, that doesn't help the market. I can't imagine it doesn't help supervisors either. So that's also why we are critical of MiCAR, at least where at the current state. It doesn't help kind of like to avoid surprises, as what we like to say as supervisors. Don't surprise us, market participants, and we do not like to surprise you. But if you have a lot of different kind of like sets of rules, it doesn't work. Well, at the moment, we see that the crypto market is kind of like merging into the normal market, so to say. So why would we have different supervisory rules?
Okay. A couple of questions from the audience before everyone here gets a final word on what should be the key priorities. The Slido thingy doesn't signal anything, so I'll have to just do it manually, like in the good old days. Yes, please, Ben.
Just a quick question, very interested in the digital debate here. When we think about digital in the context of capital markets union, it feels that actually we're looking at harmonization in the pure crypto space in MiCA, which doesn't necessarily address the aims of the capital markets union, overcoming some of the barriers that we've identified. But then we have a lot of the reviews in front of us, CSDR review, the MiFID review, the Settlement Finality Directive. Why are we not using those to create a pan-European framework for digital assets in the regulated space for the tokenized securities? And is the blockage technical issues, or is it member states that want to maintain the status quo? I'm just interested in why we're not addressing that.
Okay, anyone on the panel? Fabrizio? That's the luxury of a moderator. I don't
couldn't
actually have
hear the question, so I'm certainly the one. I can respond whatever if you.
Yes, please, go ahead.
No, I'm joking. No, I couldn't hear the question, so either you.
The question was, you're the closest to. The question was, why are we not using all the reviews that we have to create an integrated market also for the digital assets? Why do we always go and create a new silo?
The question is more for you, Tilman.
The moderator.
He was pushing it to you, Fabrizio.
Okay,
I think that Felix made a very valid point. We actually MiFID, for me, it's a single rule book. So unless anybody disagrees, MiFID and MiFID is a single rule book. We have developed a set of rules, level 1, level 2, level 3. And certainly on the transaction reporting that also Felix mentioned is a good example where we had in MiFID 1 a fragmented approach where each national competent authorities were receiving the data in their format, and with MiFID 2 we went for a single format. And we are using it. I think that in the data world we made significant effort and development, and we are probably much more advanced than many other jurisdictions in terms of data and also mechanism to receive the data, the SFTR, that is end-to-end XML, or EMEA, that now with the adoption of the technical standard will certainly contribute to better data. Now on why the Commission decided to do the ad hoc MiCA model, I'm not the right person to answer.
Okay, I'm not going to answer this either because I have. I'm also in line with those who want to have a single rule book and who want to just maybe have chapters within the single rule book if one asset class absolutely needs to have a somewhat different treatment. Any other questions from the audience? We take one more. Pedro.
Maybe bringing us back to the first round of questions, if I may, on Jürgen's point on the attractiveness of primary markets in Europe and whether the existing framework is sufficient to attract those startups when they start to go to market. Maybe to the moderator, but if not, to the other panelists, would that be, considering those companies that go elsewhere, they often go to the US, where the listing requirements, the disclosure requirements, the accounting requirements are probably the most demanding and expensive to comply with in the world. Would that be, is it about changing the rules to make them more flexible, or is it more about making the markets more liquid or allowing the market to become more liquid? To your point, Tilman, allowing the trading activity and the market activity to grow and then eventually regulate. Do we have more regulations than we need?
Okay, co-panelists, please.
As a market practitioner, I would say it's about liquidity in the markets, right? You need to have liquidity in your share. And how can you have a guarantee in Europe that you will be able to go to the right trading menu and attract liquid trading opportunities? So to me, this is the driver. And you're saying it yourself, right? The requirements for listing in the US are extremely high. So they are not making it easy for themselves at the outset. But they are doing it because they hope to attract investors more easily. So we need to work on what does it mean to have a more liquid market.
Felix, you agree with that?
No, I fully agree.
Yeah. No, I would also tend to agree that sort of targeted tweaks in the prospectus disclosure schedules are not going to move the needle. I think Jürgen said it as well. It's the trading and it's the structure of the market that has to be more integrated, that has to be more liquid. We have 450 million potential investors. The US has about 300 million. It's very strange that the US has the deeper and more liquid capital markets. It's historic reasons. It's about the slide. It's about the equity culture. It's a lot of things. And I think that what we can reasonably achieve, and this is why the Commission does focus a lot on the consolidated tape, is to have this single shop window that at least you see where is a particular equity, where it's available, where is the deepest liquidity, where is the best price, and then on that basis you make the market more attractive. And as you said, the US has the luxury to have draconian prospectus and disclosure rules because they have liquid markets. So obviously we don't have liquid markets, so we try to fiddle around on the prospectus rules to make it a bit more attractive, but we should not be detracted to actually do and address the market liquidity and the structure itself. That brings me almost to the conclusion, because each panelist, according to my marching orders, gets to voice 2 areas of prioritization that we should focus on. And we start with Gesa.
Number 1, common data standards. Back to the consolidated tape and transparency. We are seeing strong moves of the US regulators to move into common domain model. From a market practitioner perspective, I would like to see ESMA considering it. That would be extremely helpful to drive also global convergence. And then number 2, from a collateral market perspective, it's common procedures for withholding tax, relief at source. It sounds basic, but to be honest, right, this is where the pain points are. And sometimes it's also about telling our story, right? Because our tax procedures are so complex. This is why a number of international market participants are not even going down this route of considering our assets. So sometimes you have to just make it easier for international market participants to come into our markets.
Okay. Felix?
The first one we already touched upon, so that's data quality. Also from a supervisory side, where we all say we want to be a data-driven supervisor. It's not just about the reporting, but we set up this whole reporting mechanism to make sure that the supervisors effectively use and identify the risks. And there are still some steps ahead. And the other one, which has not been mentioned during this conference, but as a market abuse supervisor, I also believe that the cleanliness or the fairness of the markets is super important. And there I do see, still a lot of room to improve the supervisory cooperation due to the fact that kind of like the sophisticated market manipulator will not do that on just one market, but in a fragmented market, as Tilman showed in the beginning of this panel. we'll do it across market. And there we absolutely need also your input as the market to report any suspicious trading. That's in fact your duty. And on the supervisory side, we need to cooperate much better to effectively make sure that the markets are clean and fair.
All right, Fabrizio?
Will extremely be short because I said it already, so I will mention 3: CTP, ESAP, and DLT pilot.
CTP and?
DLT pilot.
DLT pilot.
DLT
Ah, okay.
pilot.
And finally, Jürgen?
I can only stress what Felix said. We haven't mentioned the words fairness and transparency, and I think that's things we absolutely need, since they are the very basis for the functioning of markets. If people don't trust into markets, if end users don't trust they are treated fairly, then they will abstain from markets. And well, that's one of the or combating that is one of the very reasons why we as a supervisor exist. So I'm completely with Felix.
All right, well, those were nice concluding words. We're all getting tired. It's Friday evening, so I think we better cut it now because... So thanks a lot to the audience for your patience to actually listen to this at a late stage on Friday. Thanks a lot to the panel for giving us such a sort of comprehensive and very well-informed overview on what needs to happen in the European markets, market infrastructure, the various layers. I thought it was super informative, and I thank you very much also for AFME to let me get away with the moderator role. I thought that was super relaxing. And so thanks a lot to everybody, and have a good journey home.